Hey guys, how's it going? Scott Criss here. Welcome to your mortgage rate forecast for July 12th. And here's where we're at. A little bit of news over the last couple weeks. July 3rd, the housing price index came out and May posted appreciation at 1.1%. That's a 7.1% appreciation on a year-over-year basis across the nation. The report also came out, this was by CoreLogic, showing that it was mainly the entry-level homes that actually appreciated the most. And the funny part about this whole thing is the statistics showed that there were 4 times as many renters looking to buy a home compared to homeowners looking to sell. So a 4 to 1. So that's the reason, even with the higher prices of homes, that's the reason why they believe we're still seeing appreciation, across the markets. As far as reports go, jobless claims came out today. It actually was a pretty big drop, which is usually a big impact to bonds, not so friendly of an impact. But it really had virtually no impact on bonds today. Bonds did open a little bit low, but they're actually trading a little bit better. You're probably going to notice today stocks are up. Markets really liked President Trump's press conference regarding NATO. So, and other than that, the only other reports worth mentioning was the CPI. That's showing inflation, non-energy, is up to 2.9%. So not very bond friendly. And this is the thing that's making analysts a little bit nervous about bond trading coming up down the road. But let's get to the technicals. Check out these charts. As you can see over the last couple weeks, bonds have done pretty well, stabilized, but we're beginning to develop a downward trading channel. So this is what's making some traders a little bit nervous, and so we just got to keep a close eye on this. It looks like from where we're trading right now, bonds over the next couple weeks are likely going to get worse unless there's some significant reports coming out showing that the economy's not doing so hot and people are going to want to take their money out of stocks and put it in the bond market. So what does this mean for you? Well, if we take a look at what Freddie Mac reported in June, they said the average 30-year fixed consumer got a 4.57 rate at a half of a point. And trading back in June, if you look at the charts here, was averaging pretty darn close to about 101.80, which is right where we're at now. However, this chart seems to be a little skewed lately. The MBA survey, which seems to be more accurate, is showing that over the last couple weeks, interest rates have gone down slightly, and we're now trading at a 4.84 average 30-year fixed interest rate across the U.S., which is what I think more average consumers are actually seeing. So, where does that leave us? Well, in the short term, all the investors I'm tracking are pretty bearish. They're not really hot on bonds, even though the bonds are in a flat trading channel right now. We are developing kind of this downward trading channel, bringing with it higher rates or perhaps higher fees to get those lower rates. So right now, the analysts are actually a little bit bearish on the short term, but also still pretty bearish on the long term. What is my projection? We're trading at 101.84. I think over the coming weeks, we probably won't see bonds go above 102 unless there's these significant reports that are just to kind of blow the markets away. But I think we could trade down to 101.20 based on the technicals. So if you're a consumer and you're like, hey man, when should I lock in the loan? Right now, you're pretty darn close to the ceiling. You might save 16 cents, which is not even a quarter of a point if my projections are accurate, but you could lose over a half a point if the markets actually go down and hit the bottom of that trough. So I would say if you're floating right now, you should be really super careful, and maybe the prudent thing to do if you're going to be closing your escrow in the next couple weeks is to consider locking actually. So nobody has a crystal ball, but that's what I'm calling. Anyway, that's it for now, guys. Leave your comments down below. Love to hear from you. Any questions? I always respond to everybody. Before you go, don't forget to hit that like button. And if none of this made sense to you, it's okay. Over at the top right, that is going to be Mortgage Bonds 101, and that'll teach you the basics that you need to know and why this kind of stuff is important when you're trying to figure out the best time to lock in your interest rate to get the best deal. Anyway, that's it for this week. See you in a couple weeks. Talk to you soon. Bye-bye.